Thanks again for coming along to the Q1 webinar. For those who don't know me or haven't seen me before, my name's Luke. I'm CEO. I'm one of the portfolio managers here at Seneca. My colleague Ben Richards with me today. And yeah, we run the sort of Aussie shares and Australian small cap strategies here at Seneca. These quarterlies, we do them about 4 weeks after the end of the quarter. It's really just an opportunity for people to ask questions and I suppose get a feel for what we're thinking about and doing. We'll try and keep this pretty informal for those who have been before. So if you've got questions, let me know. Session is recorded and I'll stick it on YouTube at the end. Hopefully the audio works this time a bit better than last time. All right, so yeah, as you know, it's this is Ben and I. We run this sort of large cap strategy we call it, or the Australian shares strategy. It's available as an SMA. It has been available as an SMA for 6 or 7 years now. And in January, we just launched the same strategy, but just as a wholesale managed fund for those sort of wholesale clients who want to buy it as a unit trust rather than as an SMA on platform. Same strategy, same stocks. Same. And, we've got the small cap strategy as well. That's coming up to 3 years. We've been running that, again, wholesale clients only. And that just focuses on kind of ASX, small and mid cap companies. But it's essentially we can go anywhere and do anything with that strategy that we like. Start with, I suppose, the large cap. So I'll spare you guys the sort of geopolitical commentary. That's not really what these are for. The net of all that, I suppose, is that everything got sold off during the quarter, and except really like energy and kind of safe haven assets. So, we had some pretty good resources and oil and gas exposure, which helped us outperform during the month. We're kind of in line over the last 12 months. So, whilst we had a decent month, I'm not going to, sort of sing from the rooftops about how well we're going. We're going okay. I think, the ASX has been doing a little bit better than other international markets, sort of because it's so top heavy. And that was really led by CBA, which was up, I think, 14% during the quarter. And that's, even though its earnings are pretty exposed to, higher inflation and weak consumers. And I think that was really just a flight to safety. With the rest of the banking sector was down kind of 8%. So I think it's more just about Australian investors feeling safe with CBA than anything to do with whether CBA's earnings are going to go up or not. Our portfolio is kind of tilted a little bit smaller than the index. It's not as heavy in the top 20 as the index is. I think the top 30 stocks are like 70% of the market cap of the index now. So those two factors, the fact we're smaller and kind of being more growth businesses. That's kind of why we're sort of only in line with index over the last 12 months and kind of had a roughish quarter. We've kind of used this time, though, really to kind of add to some of the stocks we think have been sort of indiscriminately sold off. And we've sort of positioned heavily now in our sort of best and brightest ideas, really. And, at least from my perspective, the portfolio is kind of in the best shape it's ever been. So, we're in a bunch of sort of high quality tech businesses, gold miners, even some select kind of consumer exposures that we're pretty excited about. So there's been, a fair bit of turnover. We've definitely, paid some brokerage in the last kind of 3 months, but I think that's going to set us up for the next 3-6 months where, we kind of are pretty happy with a kind of benchmark performance on the downside, because we know that on the upside, when the markets are going up, we typically can outperform. So if we're there or thereabouts now, we expect to be well and truly cooking with gas as markets start to recover, and that's probably already starting to play out in April across both strategies, to be honest. I'll just sort of skip over here. We've got the SMA. We run the same strategy as the fund. The fees are slightly different. The way we do it's slightly different, but the net, they're the same product, 50 grand minimum. Haven't got that on the website yet. So there's a new website branding, and this will probably look different next quarter anyway. But if you want to get involved in that, like, put some money into the fund structure, like I have, just email us and we'll get that organised for you. It's all through the same portal that you do the small cap fund for, so it's all kind of the same. All right, so I suppose I was actually struggling to figure out what I wanted to talk about this quarter without kind of just rehashing what every other fund and every other kind of broker reports putting out at the moment. So I just kind of thought I'd do global markets in 4 charts and highlight what I think is kind of most relevant and what's kind of front of mind for me. I think it's important to appreciate this is the biggest oil supply shock in history, and that's led to rising inflation expectations and bond yields. So you can see here's the oil shock kind of I suppose supply loss relative to other periods in history. And then on the right, it's just showing the importance of the oil price with respect to inflation expectations. So that's the crude price and the Melbourne Institute Inflation Expectation Survey. So I think it's just really important to understand that oil and inflation are essentially the same thing. And that significant shift in inflation expectations has driven up the risk-free rate. We lend money to the Australian government or the US government or whatever bond yield you want to look at. And as a result, we've seen a kind of 10% compression in PEs kind of across the world. These are sort of your major markets, and you can kind of see they're all kind of down, roughly 10% to the end of March. Fortunately, in April, that's pretty much reversed, and they're all back kind of at 100 now to where they were in a relative sense. So that's positive, but that's pretty much what's happened over the last quarter in a real kind of basic nutshell kind of way, and that's kind of all I'm really focused on at the moment is just inflation expectations, and what impact that has on valuations and company earnings, longer term. This is definitely the best sort of chart Twitter thing Ben sent to me during the quarter, and we've seen a real recovery in markets, and the S&P 500 is trading at all-time highs, but only 2.4% of companies are trading at 52-week highs at the moment, which is out of the 792 days when the S&P 500 has made a 52-week high since 1998. This is the fewest number of stocks that are participating in that rally. So, there's probably 2 ways to look at that. It's maybe a bit of a fragile rally that's built around a few names, or you can look at it the way that we're kind of thinking about it, and that is that these top 5 weights are getting asymmetrically bid, and there's a lot of value on offer in the rest of the index. And I think that's playing out to a lesser degree, but here in Australia as well, with kind of, as I said before, CBA doing 14% against the index, same stocks, same indices, same drivers of earnings going down 8%. So, where is that value? I think this chart sort of tells you sort of the story. The 2 red lines at the top, they're the large cap and small cap resources index. So you can see that resources has been outperforming the industrials component of the ASX. And inside both industrials and resources, respectively, large caps have outperformed small. So it's weight of money and flows and ETFs that are driving, excess returns at the moment. And we think that's opening up a pretty unique opportunity for alpha going forward. Banks have been pretty flat, and technology, the green line there, has been smoked. So there's, still lots of money on the sidelines, waiting for this sort of water wind, which I think is probably a mistake. And as money is coming back to the markets, it's typically flowing into the safer, larger companies. And I think, to be honest, that's really a function of people buying ETFs, feeling safe doing that. And that's just opening up huge valuation discrepancies between large and small companies, which is, Christmas for Benny and I. We're going to start getting into stocks. I might let Benny do the illustrious Siteminder and kick on for a bit here.
Yeah, thanks, Luke. So yeah, as we know, we like to kind of touch on a stock in each of the strategies to kind of demonstrate how we're thinking about things, what we're doing in the portfolios. Siteminder is an example of a company we actually own in both portfolios. Been adding to that recently. So it's one of our technology exposures. We've seen a lot of multiple compression and sell-off in that technology sector due to fears surrounding rising interest rates, AI disruption risk, and sector-specific headwinds potentially. We believe a lot of those are kind of overdone and creating some attractive opportunities. So some of the things we're looking for in that sector more broadly is is a competitive moat that's beyond just the code, the software, which can obviously be replicated quite easily now with these new AI tools. So things like deep customer relationships, being well embedded in workflows, high switching costs, ability to grow independently of the economic cycle, and generating good cash flow, or soon to be. So Siteminder, it's a travel technology company. It provides software that helps hotels manage bookings, pricing, and distribution across platforms like Booking.com and Airbnb. So essentially, it just reduces reliance on purely third-party tools, streamlines operations, and helps hotels maximize their utilization. So it's currently in 53,000 properties globally. Estimates about an addressable market of about 1 million properties that it could attack. So plenty of room to grow, I suppose, is the key. Due to those factors that I mentioned at the start, it's sold off, and particularly Siteminder has been impacted by this Middle East conflict, which has disrupted a lot of travel through those major airport hubs, including to Europe, which Siteminder is quite exposed to. So we think it's going to create a bit of an opportunity for pent-up demand, which we've seen in past cycles. Siteminder is in a really good position, probably the best position it's ever been in. It's growing. Its unit economics are up. LTV to CAC is up to 6.7 times from 6.1 times in the period prior. 11% average revenue per user growth. And as the chart says there, it's kind of inflecting towards profitability while continuing to grow. So we're picking those shares up at a 2.5 times EV to sales. Historically, it's traded in that 4 to 6 times post-listing. So yeah, really attractive valuation, good balance sheet, and potentially we could get some of those headwinds become tailwinds in the coming sort of 12, 24 months. So yeah, Siteminder is one we like. I'll turn now to small companies fund and just kind of cover off the quarter. So yeah, returns are there, down 14% for the quarter. Portfolio wasn't immune from the market sell-off. And as we mentioned in that breadth chart, yeah, we've seen a lot of small caps. I suppose the liquidity's come out of small caps. So things have been sold off quite indiscriminately, which you only see probably once every handful of years, and creates, yeah, in general, some of the best buying opportunities over the long term when you look back on them. So yeah, we know the fund has returned 18.3% per annum since inception, which is 7 percentage points ahead of the benchmark, which we're really happy with, but still early days. The fund's been up and going for 2.5 years right now. Yeah, been right up there in the peer group, so we look for that to continue. Yeah, I suppose to reiterate that point in terms of the buying opportunities, the investment team here has been adding to our holdings during the quarter as well. To cover off on a couple of changes and how we're positioning the portfolio. So taking some profits in some of the mining services names. We felt there's been a bit of overcrowding there, particularly with generalist fund managers, and also taking some profits in the energy sector, namely oil producers and uranium companies, which have done quite well given this energy crisis and price spikes. Historically, these sell-offs create opportunities to add to these market-exposed businesses. So some of these, we saw it last year in April. Market was down, 15% intra-month, and recovered in the same month. And what you would have done well buying there was certain market-exposed businesses. We've got a view of our preferred businesses that we've been adding to in that sector. As a general rule, that includes things like fund managers, platforms, brokers, and other high-growth businesses that are kind of higher beta and sell off when there's a market downturn. So yeah, we've been adding to financials and technologies, as we've mentioned. But primarily we're still looking, like the large cap strategy, for stock-specific catalysts. So with that said, jump into some charts on small caps. Do you want to do a couple of those?
Yeah, sure. So kind of what I was saying before as well. This is just another way of saying the same thing. Small caps are cheap relative to large cap right now, and I think that's pretty obvious obviously because of ETF flows. This is just showing you the small orders, some of the value that's on offer. It's pretty compelling value. I mean, hasn't been really cheaper since kind of 2011. So, good deal on that front. We've been doing pretty well, buying and selling some of these kind of high growth, high tech businesses. This is like our buys and sells in Catapult. So we like Catapult. It's good business, but like all stocks, it can get expensive. And we bought it really well in 2024, sold it kind of as it kind of got expensive. And we've just bought it back again, kind of, low threes.
Pretty recently, yeah.
So, it's a really good, it's a business we know well. We understand the dynamics of. We talk about businesses that we think are, immune from being disrupted by AI, and are actually, probably a beneficiary from AI, and kind of operating in a good market structure. When Ben talks about moats and businesses that can, I suppose, sustain themselves through periods of lower sales or lower growth, you want to find those companies that do have favorable market dynamics that they operate in. And I think Catapult there is a clear leader in what they do, and it's a growing market with more money in it every kind of year. We've spoken lots about Catapult and why we like it over the journey, probably if you go back to that sort of 2024 period, but it's a good business, and I suppose it just shows you that we are sort of, just because we sell something doesn't mean we won't buy it back again at the right price.
Yeah, good example of our process, I suppose, just in terms of, we're not always going to get that timing exactly perfect, but yeah, we think in the aggregate that works.
I think also, just sort of going, I probably should keep the slide up, but it also shows like the valuation kind of discipline that we run here. We like Catapult. Our views along the entire price chart didn't really change on the business, but the price we're willing to pay for it did change. So I think it's important and to not fall in love with stocks, and I think a lot of fund managers and individual investors too, they like a name, they make money out of it, they hold it forever, and then you end up holding a Catapult while it falls 50%, or you hold a Life 360 while it falls 60 or 70%. So this is a Benny special, so I might just hand the reins over. This is clearly a Ben special.
Yeah, I think this is a really strong catalyst-driven idea in portfolio. So company is Venus Metals.
I think this catalyst is we're in weeks now, right?
We're in weeks.
We're hoping weeks.
We believe. So yeah, it's a sub 50 mil market cap. It's quite a small company. The small companies fund that we run is quite meaningful shareholders in this company for disclosure. And with that said, let's outline what they've got. They've basically got exposure to two primary assets, which are both to do with Rox Resources. That's RXL's You and Me gold project in Western Australia,
which we're also a shareholder of.
Yeah, so we like the project. It's the highest grade undeveloped gold project in WA, and yeah, it's basically fully funded. It's just done a huge equity raise, got the debt sorted. They're led by CEO Phil Wilding, who's been rapidly advancing that project through construction, and we expect that to be in production in the not too distant future.
So end of the year, was in the first quarter?
Well, they'll be constructing this year, probably producing next year.
Yeah,
late next year maybe. Yeah, so Venus was actually historically involved in the joint venture to do with this project, and it's ended up with 50 million shares in Rox and a 1% royalty over the You and Me project. Now we believe, the Rox shares you can put at market prices, which is worth about $23 million at current prices, which moves around a little bit with the Rox share price. And then this royalty, which we've done a lot of work in the royalty sector. And we've been over all the royalties owned by listed companies and unlisted companies. And yeah, these royalties over high-grade projects in WA with scale that are being advanced, there's very few of them that aren't in the hands of specialist royalty players. Now, the stock's undervalued. We think it's probably got 50, 60% upside, conservatively. but how do they actually realize value? So the company's undergoing a strategic review, which is currently underway. Financial advisor has been appointed. That same financial advisor just did a $300 million streaming deal with another ASX junior company with Wheaton Precious Metals, which is a large offshore specialist royalty player. We think there's really good interest in this royalty from those same players. The advisors obviously got the relationships there already.
If I had 40 million bucks, I'd buy this royalty. Like it's a really good project. Rock's are running a really good business, and they're going to make a lot of money there. They've got a lot of room to expand that you and me project, and
yeah,
they're going to end up paying a lot of money away if they let this royalty get into the hands of a Wheaton or a Franco-Nevada or a Vox royalties. So we think Rocks are going to have to get this thing back one way or the other. We think it's the best interest of shareholders, and if they don't, someone's going to pay BMC 40 million bucks for this royalty.
Yeah, these guys have a low cost of capital. We think that 40 million valuation is only on the current Rocks mine plan, which doesn't include a lot of ounces in the resource base. Even just 2 days ago, Rocks reported 5 meters at 14 grams a ton
outside the resource.
So a lot of upside there as they get deeper within that mine, we think. So yeah, how it plays out exactly, let's see. We think that they probably get an offer for the royalty that maybe brings someone else to the table for a whole company takeover. Either way, we think there's a couple of different levers to realise pretty attractive value. Righto. All
right, let's get to the boring stuff. Multi-managers. As you know, we run an investment committee at Seneca. We meet every month. We review these portfolios. It's me and JB, and then we have 3 independents. The decent quarter for the defensive strategies. So the absolute return and the defensive income strategies performing really well. Really pleased with absolute return. That's come back from the brink. So really happy we stuck fat with some of the way we've been, some of the positioning there. Aussie equities had a tough month. Again, we're probably 30-40% allocated to smaller strategies, companies that are investing in small companies there. We think that's the right thing to do in the long run, but it's going to get whacked in the short term, as we've kind of been explaining even in our strategies. Aggressive income looks bad relative to benchmark, but the benchmark's got a 50% allocation roughly to Santos and Woodside because it's the high dividend, 50% in the high dividend yield ETF, which has a huge allocation to those 2 companies. That high yield strategy outperformed the ASX by 14% during the quarter. So that won't kind of always be that or historically hasn't had that level of differential. So that should kind of work itself out in due course and kind of normalize with the oil price. But otherwise, reasonable quarter in some products, and we're still struggling in Aussie equity, which is probably less to do with Seneca's part of that portfolio and more to do with some of the managers we've selected. But again, some of those managers who we're bemoaning for the last 3 months had ripping Aprils to date. So let's just see how we go there. I don't think I'm going to throw the baby out with the bathwater just yet. From an outlook perspective, still seeing plenty of opportunities. I don't know how much more we can kind of reiterate that. While other people might be more negative on the markets, we're actually kind of as positive as we can kind of get. We think global markets kind of continue to be driven by these, Trump's latest tweets and rumors and, what's happening in the Strait Wars and all that sort of stuff. For us, that's just noise. We don't get too caught up in macro. Kind of just like to go to work, do our job every day, and kind of we read it like you do, but it's not really things that drive our decision making. In fixed income, I think you're seeing the benefits of diversification in times like this. If you've got allocations to kind of absolute return or defensive income, even aggressive income strategies. But yeah, we continue to favour kind of emerging markets and kind of non-US exposures there. From a kind of macro perspective, you're hearing this from everyone. So I feel like I've got some inflation. Interest rates probably going to have to go up again. And I think market pricing in another hike coming up soon, at least 1 or 2 more before the end of the year. And we've got a productivity crisis here in Australia, and we need to kind of fix that. So yeah, that's kind of our thoughts sort of on the market more broadly. Yeah, if you want to see more of us, that's the end of the